What if I told you that right now, sitting in your wallet, there is a financial tool that the average person uses every single day, but almost nobody uses correctly? A tool that, when used the right way, quietly deposits thousands of dollars back into your pocket every single year. No side hustle, no second job, no risky investment, just a smarter way of spending the money you are already going to spend anyway. Most people swipe their credit card, pay their bill at the end of the month, and never think about it again. And that's exactly what the credit card companies are counting on. Because while the average cardholder earns maybe $200 or $300 a year in rewards, there are people out there, regular people with regular salaries and regular spending habits, who are pulling in $2,000, $3,000, even $5,000 a year in cashback, travel credits, and points just by understanding how the system actually works. Today we are going to break down that system completely. By the time this video is over, you are going to understand exactly how credit card rewards work, why most people leave enormous amounts of money on the table every single year, and the precise step-by-step strategy that can realistically get you to $3,000 in annual rewards without changing how much you spend. Welcome to Klux One Finance. Let's get into it. Before we talk strategy, we need to talk about where the money actually comes from, because most people assume credit card rewards are some kind of charity from the bank. They are not. Every single time you swipe a credit card anywhere in the world, the merchant on the other side of that transaction pays a fee. It is called an interchange fee, and it runs between 1.5% and 3.5% of the total transaction value. Every grocery store, every gas station, every online retailer, every restaurant, they all pay this fee every time a customer pays with a card. The card network, Visa, MasterCard, Amex, takes a slice of that fee. The issuing bank takes a slice, and here is the part that changes everything. A portion of that fee gets passed back to you in the form of rewards. That is the entire engine. The merchant pays, the network collects, and you receive a percentage back. Now here is what makes this interesting. Whether you pay with a rewards credit card or a regular debit card, the price at the register is the same. The merchant is paying that interchange fee regardless. The difference is simple. When you use a debit card, that money disappears into the banking system and you see none of it. When you use a rewards credit card, a portion of that fee comes back to you as cashback, points, or miles. Using a debit card for everyday purchases is, in a very real sense, leaving money on the table every single time. You are absorbing the cost of the system without receiving any of its benefits. So now that you understand where the money comes from, let us talk about the three forms it can take, because not all rewards are created equal. And understanding the difference is what separates someone who earns $300 a year from someone who earns $3,000. The first form is cashback. This is the simplest and most straightforward type of reward. You spend money, you get a percentage of it back as actual cash or a statement credit. Most cashback cards offer somewhere between 1% and 5% depending on the category of spending. Groceries, gas, dining, online shopping, each card has its own structure. Cashback is great for beginners because there is no complexity, no redemption strategy, no wondering how much your points are worth. You earn $1, you get a percentage back. Done. The second form is points. This is where things get more interesting and significantly more valuable if you understand how to use them. Cards like the Chase Sapphire series or the American Express membership rewards ecosystem give you points for every dollar you spend. Those points can then be redeemed for cashback, travel, gift cards, or transferred to airline and hotel loyalty programs. And this is where the magic happens. When you redeem points for cashback, you typically get 1 cent per point. But when you transfer those same points to an airline partner and book a flight, the value of each point can jump to 2, 3, even 5 cents. The same points used differently can be worth 5 times more. That is not a small difference. That is the difference between a free weekend getaway and a free international business class flight. The third form is miles. These are similar to points but are usually tied to a specific airline or travel ecosystem. A card like the Capital One Venture or the Chase Sapphire Preferred earns miles that can be redeemed for flights, hotels, and travel purchases. The value varies, But frequent travelers who learn to optimize their miles, redemptions, consistently get outsized value from the same spending. Now here is what most people do wrong. They pick one card, put everything on it, and collect mediocre rewards across the board. They earn 1.5% on groceries when they could be earning 4%. They earn 1% at restaurants when they could be earning 3%. Over the course of a year, across tens of thousands of dollars in spending, that gap adds up to hundreds or even thousands of dollars of lost rewards. And the fix is not complicated. It is a strategy called card stacking, and it is the core engine behind earning $3,000 a year in rewards. Card stacking means using 2 to 3 credit cards simultaneously, each one optimized for a different spending category, so that every dollar you spend is always earning the highest possible reward rate. Think of it like this. You would not use the same tool for every job in your house. A hammer is not a screwdriver. A credit card optimized for travel is not the right card to use at the grocery store. You match the right card to the right purchase every single time, and the difference in what you earn is dramatic. Let me walk you through a real example of a powerful 3-card stack that anyone can build. Your first card is your food and dining card. Something like the American Express Gold Card gives you 4 points per dollar spent at restaurants and 4 points per dollar at U.S. supermarkets. For the average household spending $800 a month on food, and that is a pretty conservative estimate when you add up groceries, takeout, and restaurants, that comes to $9,600 a year on food alone. At 4 points per dollar, you are earning 38,400 points just from eating. At a conservative redemption value of 1 cent per point, that is $384. But if you transfer those points to an airline partner and get 2 cents per point in value, that same food spending just generated over $750 in travel value from groceries and restaurants alone. Your second card is your travel and catch-all card. Something like the Chase Sapphire Preferred gives you 3 points per dollar on dining, 2 points on travel and transit, and 1 point on everything else. This becomes your card for booking flights, hotels, Uber rides, and streaming subscriptions. Everything that has a travel or lifestyle component goes on this card. Your third card is your flat rate cashback backup. For every purchase that does not earn a bonus rate on your first 2 cards, hardware stores, medical bills, random online shopping, you reach for a flat 2% cashback card like the Citi Double Cash. This ensures you are never earning less than 2% on any purchase, no matter what it is or where it is from. Now let us run the math on a household spending $3,000 per month, which is a fairly typical number for a working adult or couple in the United States. $800 goes on the food card at 4 times points. $500 goes on travel, subscriptions, and dining at 2 to 3 times points. The remaining $1,700 goes on the 2% cashback card. When you add it all up conservatively, you are looking at somewhere between $1,200 and $1,500 in annual rewards just from the baseline card strategy, before welcome bonuses, before optimized point transfers, before elevated spending periods. And this is where the number really starts to climb, because the single fastest way to accelerate your rewards earnings is something almost nobody talks about seriously enough. Welcome bonuses. Nearly every premium rewards card on the market comes with a welcome offer, and those offers are enormous. A typical example looks like this. Spend $4,000 in the first 3 months after opening the card and receive 60,000 bonus points. 60,000 Chase Ultimate Rewards points are worth $750 when redeemed through the Chase Travel Portal. Transfer them to a partner like Hyatt or United Airlines, and you might get $1,200 or more in value from a bonus you earned just by paying your normal bills through a new card for 90 days. The key insight here is that you do not need to spend extra money to hit these welcome bonus thresholds. You simply route your existing planned spending through the new card. Your rent, your groceries, your insurance payments, your phone bill, your subscriptions, your gas, all of it goes on the new card for 3 months. You were going to spend that money anyway. The only difference is now you are getting paid thousands of points for doing it. One well-chosen welcome bonus per year, pursued responsibly, can add $500 to $1,000 to your annual rewards total on its own. Add that to your base card stacking earnings, and you are already at $2,000 to $2,500 a year. You are close to 3,000 before you have even touched the most powerful part of the system. That most powerful part is optimized redemption. Because the truth is, most people earn points and then destroy half their value by redeeming them wrong. And this is not their fault. Credit card companies make the worst redemption options the most obvious and the most convenient. They want you to redeem your points for statement credits at 1 cent per point because that is the least valuable option for you. So let us flip that. The lowest value redemption you will almost always encounter is using points for gift cards or merchandise. You might get less than 1 cent per point. Never do this. The next level up is statement credits, which gives you exactly 1 cent per point. Travel portal redemptions are where the math starts to improve significantly. Cards like the Chase Sapphire Preferred boost your point value by 25% when you book travel through their portal. That 60,000 point bonus suddenly becomes $750 instead of $600. But the highest level of redemption, the one that transforms good rewards earners into exceptional ones, is transferring your points to airline and hotel loyalty partners. When you move your Chase Ultimate Rewards or Amex membership rewards points to programs like World of Hyatt, United Mileage Plus, Air France Flying Blue, or Singapore Airlines KrisFlyer, you can find redemptions worth 2, 3, even 5 cents per point. Business class flight to Europe that would cost $4,000 in cash might be bookable for 60,000 transferred points. That is a redemption value of 6.5 cents per point, more than 6 times what you would get from a simple statement credit. You do not have to play at that level to earn $3,000 a year. Simple cashback and travel portal redemptions will absolutely get you there. But if you ever want to push beyond that, if you want to start taking business class international trips for nearly free, point transfers are the path. Now, before we get to the action plan, we need to talk about the mistakes, because there are 5 specific mistakes that quietly destroy the reward strategies of people who are otherwise doing everything right. The first and most important mistake is carrying a balance. If you are paying interest on a credit card, this entire strategy collapses immediately. The average credit card interest rate right now is somewhere between 20 and 29% annually. No rewards card on the planet pays you 29% back. If you carry a balance even for 1 month, the interest charges will completely erase whatever rewards you earn that month and then some. This strategy is only for people who pay their balance in full every single month. If that is not where you are yet, get there first. Pay off your existing card debt before you think about optimizing rewards. The second mistake is applying for too many cards too quickly. Every new credit card application results in a hard inquiry on your credit report, which temporarily lowers your score. If you apply for 5 cards in 3 months, your credit score drops, lenders get nervous, and you may get denied for better cards down the road. Space your applications out. 1 new card every 6 months to a year is a reasonable pace for most people. The third mistake is ignoring or miscalculating annual fees. A card with a $95 annual fee is not necessarily bad. In fact, many of the best rewards cards charge exactly that, and they more than justify it through the value they provide. A card that gives you a $300 annual travel credit, airport lounge access, and 4 points per dollar at restaurants is worth paying $95 for. But you need to do the math. Add up the value of every benefit you actually use. If the total exceeds the fee, keep it. If not, downgrade or cancel it before the next fee hits. The fourth mistake is using the wrong card for each purchase. This sounds obvious, but it is incredibly common. People pull out whichever card they touch last, rather than the one that earns the most for that specific purchase. Your 4 times dining card at the grocery store, while your everyday card sits in your wallet. Now you know. The credit card companies have been profiting from your spending for years. There is nothing wrong with learning to profit from it yourself. If this video gave you value, please hit the like button. It genuinely helps this channel reach more people who need to hear this. Subscribe to Klux One Finance if you have not already, and hit the bell notification so you never miss a video. Every week we break down money, credit, and wealth building strategies in plain language that anyone can apply. I will see you in the next one.